How did a company that basically rents desks evolve into a $47 billion so-called tech disruptor? How did WeWork captivate investors with a promise that went far beyond real estate, only to unravel so swiftly? This story reveals complex forces at play, from visionary founder charisma to unchecked ambitions. The peak valuation of $47 billion in early 2019 framed WeWork as a unicorn. But was that image too good to be true? WeWork started in 2010, founded by Adam Neumann and Miguel McKelvey. Though their business focused on leasing office space, essentially real estate, they promoted themselves as a technology company. This positioning blurred lines, creating an aura of innovation around a fundamentally traditional sector. Yet their early branding laid the groundwork for an aggressive growth strategy based on community and culture, not just square footage.
SoftBank became the largest single investor in WeWork by injecting over $10 billion through its Vision Fund. This massive capital infusion underpinned WeWork's rapid expansion, fueling a growth pace few companies could sustain. Such a level of investment raised questions about how conventional real estate-driven cash flows could justify such high confidence and valuation from SoftBank's aggressive funding approach in 2019.
By January 2019, WeWork's private valuation peaked at $47 billion, largely driven by SoftBank's Vision Fund investments. This extraordinary market excitement positioned WeWork as a benchmark for startup growth, boosting its profile far beyond typical real estate companies. Yet, behind that spike lay fundamental financial and governance questions that soon captured investors' attention and foreshadowed future upheaval. What happens when a company's confidential books are finally opened for the world to see? WeWork's S1 IPO filing in August 2019 revealed a staggering net loss of $1.9 billion against $1.8 billion in revenue for 2018. This disclosure exposed a startling reality. Rapid growth was hiding deep financial wounds. Investors suddenly realized the scale of losses that had fueled WeWork's sky-high valuation. The filing also revealed severe governance red flags. Founder Adam Neumann held supervoting shares with 20 times the voting power per share, entrenching his control. He sold the We trademark to WeWork for $5.9 million, a clear conflict of interest. A controversial succession clause even gave his wife, Rebecca Neumann, unusual influence. This mix of founder dominance and self-dealing alarmed prospective investors. How swiftly can a CEO lose his grip when the market rejects his vision? Investor pressure forced WeWork to withdraw its S1 filing and postpone its IPO on September 17, 2019. Just a week later, Adam Neumann stepped down as CEO on September 24, 2019, marking the rapid unraveling of leadership amid an evaporating valuation that had once soared near $47 billion. Why does the person who steered the company toward disaster receive the luxury lifeboat? In October 2019, SoftBank arranged a bailout that valued WeWork at under $8 billion and gave SoftBank majority ownership. Adam Neumann walked away with about $445 million in cash and stock as part of his exit package. This deal raised questions about accountability amid a crumbling enterprise. The question remains, can WeWork's 2021 public debut through a special purpose acquisition company mask the scars left by its earlier failures? This SPAC merger valued the company at $9 billion, a steep drop from past private peaks. The modest market response suggested lingering skepticism despite the fresh start on the public markets. The move underscored ongoing challenges in restoring investor confidence after the tumultuous leadership and governance crises just 2 years prior. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy protection across the United States and Canada. The company listed liabilities between $10 and $50 billion, reflecting the immense financial strain beneath its workspace ambitions. This filing marked a pivotal moment when debt pressures overwhelmed WeWork's capacity to operate sustainably. Before declaring bankruptcy, WeWork carried more than $4.2 billion in outstanding debt obligations. Its total assets stood at $15 billion, overshadowed by $18.6 billion in debt. This imbalance between assets and liabilities illustrated how WeWork's financial structure had become unsustainable, despite carrying significant property holdings and leasing commitments. Emerging from bankruptcy in May 2024, WeWork eliminated nearly $4 billion in debt through a restructuring of unprofitable leases. This turnaround included renegotiations that shed excess obligations and adjusted the company's footprint to align with market realities. While no longer the industry agitator it once was, WeWork sought a more manageable, sustainable path forward. The restructuring phase marked a pivotal moment for WeWork. Yardi Systems, a real estate technology firm, acquired a 60% stake, reshaping ownership and control. Adam Neumann, the company's charismatic founder, attempted to regain control with a bid exceeding $500 million. His offer was rejected, effectively locking him out of the company he once built. This exclusion raises profound questions about the limits of founder influence in the aftermath of corporate crisis. From a peak valuation near $47 billion to bankruptcy filings listing tens of billions in debt, WeWork's journey underscores a hard truth. Ambition unchecked by governance and sustainable economics can imperil even the most hyped ventures. Their story is a stark reminder that innovative visions require disciplined stewardship. Every week, one story, one lesson. Subscribe, because the next one is already being researched.